Greetings, everybody. Welcome to Monday's Liberty Call. It is Monday, January 9th, 2023. Sorry. You're probably like me. You probably write 2022 on them, like your checks and stuff like that. Usually, I remember being in school growing up as a kid, and you would always, put the wrong date on for the first few weeks of the year. So this is the first time I've messed up, so not too bad. So anyways, I hope everyone had a fantastical weekend. It's kind of gloomy here in Colorado. It was sunny this morning, but kind of overcast. We might get a little bit of snow on Wednesday, but it looks like a storm system's coming through and, making my sinuses hurt. So if you're one of those people out there in the world whose sinuses are easily affected by barometric pressure, whatever's moving across the United States may be heading your way real soon. So anyways, if it's your first time watching, give me some thumbs up, some likes, shares, subscribes. I would greatly appreciate it. And looks like the market, it looked really good most of the day. And then the Dow and the S&P, kind of took a nosedive. So again, not surprising, we're in this long-term decline. Yeah, we do have some upswings, from time to time, but until we do bottom out, which I would forecast somewhere, late spring, summertime, just based upon averages. That's what I'm kind of forecasting. Granted, things can change, and depending upon what the Fed does and everything that they're trying to do to fix the problem that they created, we shall see. So, all right, well, let's go ahead and jump into the numbers and see how they turned out for today. The Dow Jones was down 0.34% or 112 points, closed at 33,517. SP 500 was down 0.09, so pretty much flat for the day, closed at 3891. NASDAQ was up 0.63. It was up more than 1%, most of the day. Closed at 10,635. Small caps are up 0.41. The VIX was up 3.93%. It's currently holding at 2196. Canada was up 0.21. Brazil down 0.12. That may have something to do with all the consternation down there with what's going on in their capital. Mexico was up 1.07%. Jumping across the Atlantic, let's see how the Western European markets did. Germany was up 1.25. UK was up 0.33. France was up 0.68. The Euro Stoxx was up 1.26. Netherlands was up 1.65. Spain down 0.07, so pretty much flat. Italy up 0.81. Switzerland up 0.61. And Portugal up 0.3. In Russia, both exchanges were in the green today. The MOEX up 0.33, the RTSI up 3.72%. And the overnights look pretty good in Asia. In Japan, they were up 0.59. Same with Australia, 0.59. In the Chinese markets, the Shanghai was up 0.58, the SCSE component up 0.72, the China A50 up 0.97, DJ Shanghai up 0.7, and the Hang Seng up 1.89%. Taiwan weighted came in up 2.64%. So a pretty good day across most of the globe. Like I said, things kind of took a bit of a turn here at the end of the market for today, but again, not really surprised. Anyone who thinks that we're going to go on some extended rally just because the Fed has slowed down their pace of rate increases, again, don't get your horses, don't get too far ahead. Hold your horses and don't count your chickens before they hatch. So, all right, well, let's go ahead and peruse this week's weekly economic update. The week on Wall Street, a strong Friday rally triggered by fresh signs of moderating inflation pushed stocks into positive territory to begin the new year. The Dow Industrial Average rose 1.46%, while the SP 500 was up 1.45. NASDAQ was up 0.98, and internationals were up 0.9. Stocks rally. A new year did little to change the market's overall tenor as trading remained choppy. The first two trading sessions of a holiday-shortened week saw major averages swing wildly between gains and losses as investors balanced an improving outlook on inflation against concerns of faltering economic growth. Mega-cap technology and other high-growth names endured the brunt of the selling pressure. Stocks took a decisive turn lower Thursday on strong private payroll growth and declining jobs claims, which heightened fears that the Fed would need to push interest rates higher for longer. However, stocks staged a powerful rally on Friday despite another strong jobs number, partly due to a deceleration in wage growth. The labor market juggernaut. The Fed has communicated that it is looking for weakness in the labor market before it can feel confident in higher rates are working to slow inflation. Employment reports last week indicated that the Fed might need to wait a bit longer for evidence of a fading labor market. ADP's monthly employment report showed the private sector adding more than 235,000 jobs than consensus estimates of 153,000, with strong wage gains over the last year, plus 7.3%. Initial and continuing job claims fell in the last week of December and remained at pre-pandemic levels. Finally, the government's monthly employment report showed employers adding a healthy 223,000 jobs in December. So, and let me pause there. I mean, I know that a lot of people are talking about the Fed is watching the employment reports because they're looking for, unemployment to rise. I mean, it may seem a little disjointed to think that way as far as, that their goal is to put more people out of work and that's going to stymie inflation. Not really, because, the more people who are out of work, that's less productive that the economy is. The goal of raising interest rates ultimately is to create more savers. Instead of people just spending money in the economy, they're actually saving it into, savings accounts, bonds, things like that. And by raising the rate of interest, it's to slow down the spending in the economy so that more people are saving for that future rainy day, because the yield that you're receiving on those savings is more advantageous, to the person who's actually, putting that money aside. So, don't get me wrong, as far as, all these articles that I cover from week to week about, how the Fed is paying attention to the employment numbers. Yes, they do want to pay attention to that, but, the goal isn't to put people out of work. I mean, that's, it's to have people, instead of spending, 5% of their, disposable income on crap, that they're socking it away for, a future rainy day, which again, pulls that money out of the economy and, stashes it away where it's, earning that person some yield, and again, slows down the amount of spending in the economy. So again, the folks out there who just think that the Fed is trying to, put people out of business, that's not the goal. Granted, it is going to occur. I mean, as we bottom out in whatever is going to occur here in the, over the next year or two, businesses are going to go out of business simply because every time we go through a bottoming of a market cycle, it flushes out all the malinvestment in the system. And, the successful companies will either consolidate with, the failing companies, or the failing companies will just go out of business. And then also, new companies will then be started along the way, because, there will be new needs in the economy for people to, whether or not it's cleaning out septic tanks or picking up trash or whatever the case may be, there's always going to be some new innovation that's going to come along down the road. So, all right, that was my soapbox moment there. As far as economic data coming out this week, not a whole lot. Thursday, we have the Consumer Price Index and jobless claims. Friday, we have consumer sentiment. We do have a handful of companies reporting earnings this week. Friday, we have Bank of America, JP Morgan, Delta Airlines, United Health Group, Citigroup, Wells Fargo, and BlackRock. All right, so that's everything in the weekly update. Let's peruse through today's market recap. S&P 500 jumps as bets on less hawkish Fed fuel tech rally. Again, these journalists think that they can will it into existence, that the Fed is going to just, slash rates, do more QE, give the economy some sort of a sugar rush that's going to propel the stock markets onto bigger and greater things. But again, we've seen what the last 20 years have done, keeping interest rates at or near zero, especially after the financial collapse in 2008 and 2009. We're dealing with those consequences right now. So I don't know if, slashing and burning rates to such low levels again is really going to be a good thing. I look at it as rates are now normalizing back to where they should have been, probably for the better part of the last decade. And, if interest rates go up into the teens, that's a little higher than normal. But, the cost of borrowing money should not be free. And that's what's led to a lot of the problems that we're dealing with today. All right. The S&P 500 jumped above a key milestone Monday, powered by tech, as falling Treasury yields continue to drive up prices amid ongoing expectations that the Federal Reserve will slow its pace of rate hikes. Again, I don't think that's going to occur. The U.S. 10-year Treasury yield fell to its lowest levels in 3 weeks, extending its move lower from Friday when the December jobs report showed cooling wage pressures, helping rate-sensitive sectors, including tech, flourish as investors continued to price in a less hawkish Fed. Fed funds futures showed bets on peak levels of rates slipped below 5% from a week ago. Apple, Microsoft, and Alphabet led gains in tech, while semiconductor stocks were lifted by more than 7% rise in NVIDIA following a slew of positive remarks from Wall Street. NVIDIA was named as a top pick by Wells Fargo amid expectations for the chip industry downturn to bottom in the first half of the year. Credit Suisse said NVIDIA remained its top pick, quote, on the basis of de-risk gaming and catalysts from Grace Hopper this year, end quote. Tesla, meanwhile, led consumer discretionary stocks higher to extend its rebound following its plunge to a 52-week lows last week. Neuberger Berman senior research analyst Daniel Flack said Monday he would be a, quote, buyer of Tesla at current levels, end quote, describing the EV maker's business model as, quote, powerful, end quote, as it enables new services like self-driving to be delivered. Yeah, again, I'm not real keen on that self-driving cars. There was a article I read, I think last week, where a guy in Germany was on the Autobahn and he led the cops on a multi-mile chase after him because he was taking a nap while the car was zipping down the highway. So, I don't know if that's really going to be the best idea, at least under current technology. Maybe 10, 20 years down the road, we'll have Jetsons cars. You can just set your destination and your car, drives or flies or whatever down the road, and you can take a nap in the back seat. But until we get to that point, let's, slow our roll. Alrighty. Cruise stocks were also involved in heavy lifting for consumer stocks and continued to rack up gains. Norwegian Cruise Lines and Carnival Corporation were up more than 2% and 3% respectively. Energy, however, traded flat, even as ongoing demand optimism from China's reopening and weaker dollar helped pushed oil prices higher. Lululemon, however, failed to participate in the rally, falling more than 8% after cutting its guidance on margins and amid rising costs. I mean, how much can stretchy pants really cost? I can't imagine. I imagine the margins are probably quite high in that line of business. So let me pause for a second here. All right, I'm back. Sorry, had to blow my nose. Allergies are still kicking my butt. At least I can breathe through my nose right now. So, because last week I was, talking like this. All right. The company expects gross margins to fall 90 basis points to 110 basis points compared with prior guidance of an increased 10 basis points to 20 basis points. In other news, Bed Bath & Beyond rallied 33% just ahead of the home goods retailer quarterly earnings report, which is expected to show a loss of $2.38 on revenue of $1.33 billion. In cryptocurrency news, Bitcoin rose more than 2%, hitting a more than 3-week high, sending crypto-related stocks, including Marathon Digital Holdings, Coinbase, and Riot Blockchain sharply higher. All right, so that's everything there. Got one last article to cover today. Comes from our friends at First Trust. It's titled Not Goldilocks. It has to do with the employment situation. All right, not long after Friday's employment report, multiple analysts and commentators were calling it a Goldilocks report, by which they meant it showed the economy was neither too hot nor too cold, but instead just right. In turn, the theory goes, the Federal Reserve could stop raising short-term rates earlier and at a lower peak than previously expected. Inflation would continue to cool and the economy would pull off the elusive soft landing, which again, I think it's going to be more like crash and burn. That'd probably be the best way to put it. The biggest headlines from the employment report were definitely good news. Non-farm payrolls rose 223,000 in December, beating the consensus expected 203,000. Meanwhile, civilian employment, an alternative, although volatile measure of jobs that include small business startups, surged 717,000. Rapid job creation helped push the employment rate down to 3.5%, tying the lowest level since Joe Namath was the reigning Super Bowl champion. If you're a millennial or Gen Z, yes, that's the same guy in the Medicare commercials. He also did a commercial where he wore pantyhose back when I was really little. I think he shaved his legs, and it was, if I forget the brand, but he said, if make his legs look good, imagine we could do for yours. So, but I was a very small tot back then. But behind the headlines, the data were not as good. Temporary help job services fell 35,000 in December, the fifth straight monthly decline to a level of temp jobs below a year ago. Why are these jobs important to watch? Because when businesses, hold on a second. Sorry. My guard dog back here was scratching and making noise. Because when businesses face increased demand, the quickest way to respond is hiring temporary help. And the same thing happens in the opposite direction. Meanwhile, the total number of hours worked in private sector ticked down 0.1% in December, the second consecutive monthly decline. Even though payrolls were up, total hours worked data showed less work was done. Shocking in this economy. Putting it all together, this is the equivalent of losing 125,000 jobs in December, not gaining jobs. Fewer temporary workers and fewer hours worked suggest some weakness in the job market. What this means is that businesses are still hurting, but their workers have less to do. Why would businesses do that? Because finding qualified workers has been unusually difficult during the reopening from the COVID shutdowns. In turn, many firms are willing to keep hiring workers until it's clear the economy is in recession. But it also means that if a recession happens, and we continue to think it will, more workers will have to be let go. The figure that the optimists focus on the most was the wage report, which showed a relatively moderate gain of 0.3% in average hourly earnings in December and a gain of 4.6% versus a year ago. Moderate wage growth, the conventional thinking goes, diffuses the potential for a wage price spiral that keeps inflation high or even pushes it higher. But this is basic misunderstanding of inflation dynamics. As Milton Friedman taught us, it's loose money that causes inflation to go up. The fact that wages sometimes go up faster at the same time is also a sign of loose money, but it's not a sign that wage growth causes inflation. What analysts and commentators and the market should have spent more time chewing over was the ISM services report, which screamed stagflation. The overall index came in at 49.6, well below consensus expectations and the first reading in contraction territory since the onset of COVID. In fact, excluding very early COVID, it was the first sub-50 reading since 2009. Meanwhile, although the prices paid index declined to 67.6% versus a 70.0 in November, that's still higher than it ever was between mid-2011 and early 2021. This week's CPI report should show tame overall inflation for December itself, but that'll largely be due to falling energy prices. The ISM report suggests inflation isn't going back to Fed's 2% target anytime soon. Put it all together, and it looks like both the surge in M2 growth in 20 and 2021, which created the inflation, and the abrupt slowdown in 2022, which would cause slower growth, are still winding their way through the economy. If so, we should see weak economic data soon. Further forward, if the Federal Reserve maintains slow M2 growth, an open question given the Fed's reluctance to focus publicly on monetary aggregates when setting policy, we could see a major slowdown in inflation in 2024. Time and the direction of monetary policy will tell. Right now, it looks like real GDP expanded at a 2.5 to 3% rate in the last quarter of 2022, but how fast it's growing in the first quarter of 23, if at all, is anyone's guess. All right. So basically, Mr. Westbury is saying that people are focusing on the wrong stuff, which not really surprising. I mean, if you expect the people in government who are trying to save us from the problem that they created, unfortunately, they're in no hurry to lose their jobs, and unfortunately are going to put the Americans over a barrel again. So anyways, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. Hope everyone has a fantastical evening, and I'll talk to you guys next time. Adios.